Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week it was time for another of my regular monthly chats with Andrew McHattie, the editor of Investment Trust newsletter. We're now well over 6 weeks into the Iran war, and what a fascinating period it's been. As many commentators have noticed this week, it seems a little bizarre that while we don't know whether the ceasefire that's been declared by the US is going to hold or not, the US equity markets are trading at all-time highs. They've retraced all that they lost in the initial reaction to the news of the war and have now surpassed those. Nasdaq are doing even better than the S&P 500. Now, that's not true of all markets. Most equity markets are up this week, but since the launch of the war, it's not the case that every market is up. The US is an exception in that regard. The Nikkei has also done pretty well in Japan, but for most of the rest of the world, it's been a case of what are now relatively modest declines, somewhere between 1% to 4%, that sort of thing. So we don't know, but obviously there are a lot of investors out there who've decided that the Iran war is manageable in terms of its consequences. We don't know what they're going to be yet. Oil prices come back a bit. Bond yields have stabilised a little bit. But it is worth making the point, I think, that the UK market was identified this week as one of the ones most vulnerable to a supply shock in the oil markets. And the equity market here has been among the worst performers. And the great majority of gilts have also sold off. So yields are still rising there. So I'm afraid the international verdict that we are most vulnerable to a return of inflation from this kind of supply shock is being borne out, at least in the way that the markets have reacted. So I kick off, Andrew, by asking you just quickly for a comment on what you make of all these developments with regard to the Iran war. Have you, as surprised as some people are by the way that everything has bounced back in the US at least?
Well, I am, and rather like many other commentators, I'm somewhat puzzled by it because I do feel that there are numerous consequences to follow from the disruption that we've seen, even if the ceasefire does hold now, because it takes some time for supply chain disruption to follow through into its end markets, and it takes time for the inflationary impact to be felt. And there's no doubt, really, that the oil price is going to settle at a higher level than it was before the conflict began. So we are going to see higher fuel prices. And as well, there are numerous problems, I think, that are in the offing, whether it's fertilizer supply or food prices. And we've yet to feel all of those. So normally, the stock market is a great discounting mechanism. And it's tremendous at looking forward and anticipating the issues. But I'm feeling now that it's probably a bit too influenced by the day-to-day news flow coming out of the White House. And my feeling is that once this news cycle has passed and maybe things have settled down in the Middle East, we may see reality start to bite and it's not going to be comfortable.
Indeed. I mean, not everybody can be right about this. There have been a lot of people, quite well-known investors, who come out very strongly saying this is a negative and will have serious consequences either on inflation or on economic growth, or possibly both. And yet the markets don't seem to be taking that medicine, if you like, so far. But as you say, it's early days. I think what we do know is that Donald Trump is very aware of what the stock market does, and he regards that as one of his key indicators of how well he's doing. He is doing very poorly in the polls, and there's certainly a significant risk that he will lose control of the Congress in the autumn midterm elections. But the stock market is up. And I did read a small item last week, which I may have mentioned last week, that Scott Bessent, the US Treasury Secretary, had a meeting with senior financial figures on Wall Street, presumably the usual suspects, Jamie Dimon of JP Morgan and others, and kind of gave them the message that this thing would be over soon, as far as the US was concerned. And that was followed the next day by the first rally in the stock market. So maybe there's something in that. But whether that leaves us in a better or worse place, that will all depend on what the outcome is of the negotiations between the US and the Iranians. So that's the backcloth, the market. The investment trust index has performed okay this week. And the discount on average has come in a little bit to just over 11%. As of this morning, Friday. But there's lots of news, of course, and that's what we always like to talk about most here on the podcast. And I think we might kick off with talking about the latest developments in the Saba Capital targets ongoing saga. And there's a couple of things that happened this week. But first off, let's kick off with the latest news coming out of Edinburgh Worldwide, the Baillie Gifford Global Smaller Companies Trust, which has been one of the original 7 targets that Saba's been looking to take over. Can you update us on what's been happening there this week, Andrew, and what you make of it?
As you say, Jonathan, Edinburgh Worldwide was one of Saba's original targets when it first made itself known in the investment trust sector, and it's been back for a few bites since. And there was another vote actually last week, which was for a proposed exit option for shareholders. And finally, Saba won this vote, or rather, the board didn't. So this vote needed 50% approval by shareholders to go through, which was going to enable shareholders in Edinburgh Worldwide to choose to exit some of their shares. But actually, only 46% voted for this and 54% against. So now that that vote is not going through, effectively, the board is unable to proceed with its plans. And there's another vote now coming up on the 30th of this month for Saba to possibly take control of the board by putting its proposed directors onto the board. So if that does happen, it's very likely, I think, that Saba will take control of this trust. And we'll have to then see what the next step is. The shares are currently on a small discount of about 3%. There could be an opportunity still to come for shareholders to exit close to NAV, or they may find themselves in a trust that actually then adopts a very different approach. So I don't know. This is a step forward for Saba, possibly a step backwards for corporate governance in the investment trust sector again. I wouldn't want to be holding Edinburgh Worldwide myself at this point, but this is what happens, I think, when a trust gets caught in the Saba blender. There's a real mess left behind.
I think it's fair to say that there's also a proposal that Saba themselves have put forward, which I think is a sort of compromise, if you like, which they had verbally agreed with the board of Edinburgh Worldwide, that somehow this trust would maintain its holding, or shareholders have an option to hang on to their SpaceX shares. That's the big space company which is meant to be IPOing quite soon and has lit a small explosive device under the shares of any company that owns it, such as Scottish Mortgage and other Baillie Gifford trusts. And the board says that that was what they had agreed with Saba, but Saba are now saying that they're not going to vote for anything that the board puts forward. So that's a bit of a standoff, isn't it? And we don't quite know, as you say, exactly what options the shareholders will be offered with in terms of the exit potential.
I think that's right. So Saba don't have a great track record of sticking to their word, and they have indeed said they're basically not going to collaborate with the board at all now. I think they're hoping that they will gain control at the next vote. So until then, they don't really need to commit to anything. So on that basis, I feel that you're somewhat in the dark as an ordinary shareholder of Edinburgh Worldwide, and you don't know whether you're going to be able to benefit from further gains in SpaceX going forward, and you don't really know what kind of trust you're going to be in. And this is the problem when not everybody votes in all of the votes that are called. And of course, it's natural that people get tired of being asked to vote on different proposals every few weeks, which is what's happened in this case. So it's not that surprising that Saba have finally managed to win one. And of course, now we don't really know what's going to happen.
Yes, and I think there has, as you say, been a lot of concern about the corporate governance implications of this. I suppose one has to make the point that Edinburgh Worldwide performance has been pretty dire, frankly, over the last 5 years. They have taken steps to try and improve it. There was a 68% turnout, I think, for this week's vote, which is pretty much similar to what they managed to get, not quite as big as they managed to get last year. So shareholders have been very loyal, I think, on the whole, to the board, but one wonders how far that loyalty has been driven by a concern to rebuff Saba because of the way they've operated, and how far they actually do really like the way that the trust has performed over the last few years. Let's put it that way. You know, they want the trust to continue, but would they actually carry on holding the shares? It's noticeable this week, I think, that in that vote, Saba did get the support of 2 other institutional investors. We don't know who they are. I mean, I've heard suggested names of who they are. I don't know if you have. But that was what really tipped them over the edge into winning that vote. One of them, I think, is meant to be another hedge fund. But it does seem as if enough shareholders have actually been selling in the market to drive this as well. So do you think that shareholders really think that Edinburgh Worldwide deserves to survive? Let's put it that way.
That's a tough question. And I fully understand the discussion over this, actually, because you're quite right. The 5-year track record is awful at Edinburgh worldwide. But, trusts do go through poor periods. And actually, with its meaningful holding in SpaceX, which is more than 20% of NAV now, of course, the 1-year performance looks so much better. So maybe that was just a cyclical issue. It's hard to know, isn't it, whether actually shareholders really like the trust or not. But in terms of Saba's situation and whether it's persuading other investors of its case, I think maybe we could say that partly through its longevity now, Saba is being somewhat institutionalized in this sector. And there's an increasing recognition, I think, that it's an important player in our sector now, and it's going to remain so. And so perhaps some other shareholders in the sector, some other stakeholders are feeling that it is the time to start working with Saba to see if they can actually reach a better outcome. And yes, you could argue maybe Saba are having a positive impact here.
I was just looking through the latest holdings disclosed or estimated holdings that Saba have, and I think it's something like 50 investment trusts now they have a stake in, which, given that there's only 250 or so in the universe, that's quite a significant holding. And their combined holdings, at least according to one estimate I've seen, is now around 2.5 billion sterling, which is a significant amount of cash, albeit not a huge percentage of the overall capitalization of the investment trust sector. But it is becoming a significant player in a lot of situations. And I just wonder whether the boards of trusts, they've disclosed some more stakes more recently. They've moved into the alternative asset sector. They're going to have more capital coming in from Smithson and possibly Edinburgh Worldwide and so on. They're going to have more capital to play with. And I think it really is a case that if boards of a trust which are vulnerable or have them on the share register don't get busy and don't tackle this problem head on, they are going to find themselves possibly going the same way. I mean, around a dozen of the trusts, I think, in which Saba has disclosed a stake, have, through one means or another, left the investment trust sector, either through enforced mergers or through wind-ups or whatever. So they are having an impact, significant impact. And other trusts may follow unless boards can indeed get their act together, bearing in mind and recognizing that, as Edinburgh Worldwide and others have said, it's actually quite difficult to deal with them, despite their significant shareholdings, because they won't engage. They simply won't engage. Or at least they do engage behind closed doors, but they never really come through with agreements as a result, or very rarely come through with agreements. Have been some. We might just mention in this context Impax Environmental Markets, ticker IEM, which is another trust which is in a very similar position to Edinburgh Worldwide. Can you remind us what's going on there, Andrew?
Yes, with Impax Environmental Markets, this is a trust that I think is probably going to disappear because this was another trust actually where its continuation exit option was defeated. So it then fell back onto what it called its backstop tender offer, which is effectively allowing shareholders to exit before Saba can take control. And actually, today is the last day to tender shares. So if you haven't done that, you've missed it. But it's going to be very interesting to see what proportion of shareholders have decided to exit and how many are staying. And I think this is going to be a really important figure to look at because it gives us a signal for what's going to happen going forward, I think, for other trusts. Because should Saba find that actually the take up of the tender was extremely high, so they are left with a massive stake in the trust and it effectively doesn't become governable as a continuing investment trust, then they may feel that this is not a tactic they wish to pursue any further. But if a reasonable number of shareholders have stayed, which is either because they didn't really realize what was going on and didn't tender their shares, or because they support Saba, and in that case, the trust may have a continuing amount of assets that's worth carrying on with, then I can see Saba just repeating the strategy over and over again. But the problem for me with all of this is a question really of timeframes, because yes, I think it's very reasonable to argue that Saba are providing an uplift in value in the near term, and they're enriching themselves and maybe a few other shareholders along the way. But of course, what they're doing is they're removing these investment trusts from our sector so that we have no opportunity to invest in them from this point onwards. And we have no opportunity to take a long-term view. And coming back to Edinburgh Worldwide, yes, its 5-year track record is awful, but actually, perhaps I want to hold it for 20 years. but I'm not allowed to do that anymore because it's not going to exist in the same format. So that's the problem for me, that actually Saba are really shrinking the sector quite considerably and removing these trusts from our future opportunity set.
Yes, and in that context, it's perhaps worth making the point that Edinburgh worldwide has a market cap of around 750 million, something like that. Impax environmental markets is a bit bigger, 830 million, I think, according to the numbers I'm looking at. And then we compare that with the Herald, of course, one of the other targets, which is 1.2 billion or so. I mean, these are chunky trusts. These are trusts that have raised a lot of money from the London market and will be either disappearing or staggering on in a kind of reduced form at best. So, yes, they have become significant players. And that, of course, if Saba do take the money in one or two cases, they will then have more ammunition to put back into the market. So they can take bigger stakes in other entities. So that is where Saba is at the moment. And as I say, they're still building stakes. They are reducing in one or two places, but they are still building stakes in a number of trusts. They have taken money, as you say, taken profits on a few, but the majority of they're still hanging in there and will be here for some time, as you say. So perhaps in that context, I might just mention one other thing that's happened this week. The confirmation that two BlackRock investment trusts, smaller companies trusts, BlackRock Throgmorton and BlackRock Smaller Companies, have completed the merger, which is very much driven by the threat, at least, of Saba coming onto their share registers. And in the case of Throgmorton, certainly they were there. And that merger has gone through, but a significant amount of shareholders in Throgmorton, which is the trust that's being merged into the BlackRock Smaller Companies, more than 50% opted for a cash exit. They weren't allowed to take out that much, but that's what they voted to do. And one of the small consequences of that is that another trust, JP Morgan Cloverhouse, has been promoted into the FTSE 250 index. So that's a bit of housekeeping on Saba Capital. Let's move on and talk about something which is perhaps rather more inspiring, and that is developments with Seraphim Space, which has been one of the really top performers in the investment trust sector since last summer as a result of various factors. Perhaps you can tell us what the latest news from Seraphim Space is. I think it was trailed last week, but the actual details of what they're planning to do came out this week. So perhaps you can fill us in on that, Andrew.
I will gladly talk about this, Jonathan, because actually amidst all of the rather gloomy news about all of this money leaving the investment trust sector, here's a case, hopefully, of some new money coming in. So Seraphim Space, which has been on an absolute tear, actually, really boosted very much by the prospect of increased European defence spending, and I think as well just an increasing awareness of the current role of space in our ecosystem, and the fact that we've seen the excitement around the Artemis 2 trip around the moon, and we've seen the stock market excitement over the potential IPO of SpaceX to come. So there's a lot of good feeling around the space sector at the moment, and that has helped Seraphim Space shares to go to quite a large premium to their last NAV, which was 142.3, and the shares are about 179. So a very significant 20% plus premium there. And I think you have to be a little bit careful about those numbers, because I think the last NAV, which is only a quarterly figure, is probably understating the current position, particularly given one of Seraphim's major holdings, Hawkeye 360, has filed for an IPO in New York, so that may herald another uplift there. But this is all a very nice background for Seraphim to raise some new money, which is effectively what it has signaled it's going to do. So there should be a fairly major fundraising coming here through a C share issue, which is a sensible structure where effectively new money raised goes into a separate pool until it is fully invested, and then effectively that pool then merges with the ordinary shares. We don't know what the timetable is going to be yet, and we don't know how much money is going to be raised, but it could be as much as £350 million, which would more or less double the size of the trust. And I feel this is very, very good news. It's a good signal for the sector that actually it can still function as a proper fundraising mechanism for expanding companies. And I like to see the secondary market working in that way. And I do feel that Seraphim actually does have some outstanding opportunities ahead. So this is a really interesting one.
Yes, and it's fair to say it has been, we've used this term so many times, but you cannot describe it anything other than being a roller coaster ride. Because when the IPO happened initially, the shares gained about 20% pretty quickly, and then they went on a long, extended dive from 2022 onwards. They IPO'd in 2021, And then they hit sort of rock bottom in share price terms in the middle of 2023, when I think from memory they were trading at a discount of around 60% or something like that. However, they got the wind behind them, and since then it's been up all the way. And as you say, they've gone from trading at a 60% discount to trading at a significant premium. And the current share price of around 180p can be compared with the 100p or 99p issue price at IPO. So over the haul, over the last 5 to 6 years, they've done pretty well, but it has been a very bumpy ride. I've heard some mutterings in the market about this and whether or not this C-share issue, I mean, I'm sure it'll be a success. There's no doubt about that, I think. What do you think, from past experience, can we make some guess as to how the C-share issue will be priced? Will it be based on the NAV of the existing share price, or will it be based on what investors expect to be done with the C-share issue proceeds, which I don't think we know yet, do we, exactly what they're going to do with it?
No, we don't, because effectively the money will be invested in the pipeline, and we don't know too much about the pipeline, although the trust is currently explaining that to investors through roadshows and so on. Though it's going to be interesting, the shares will be priced initially at 100 pence at the launch, and then because they're a new pool of investment, it's effectively rather like an IPO, I think. And so we may see a small initial premium on that, but it won't reflect the premium to NAV on the ordinary shares, which are fully invested. So effectively, until the two pools merge, I think they're probably best treated almost as two separate trusts, two separate entities, one of which is fully invested and the other one of which is quite new and is still putting its money to work. So they'll be valued separately by the market. Of course, the question you're really asking, Jonathan, is should you consider investing in the C shares or not, or just stick to the ordinary ones? And my feeling is that actually, if you're a short-term investor looking really to benefit from volatility in the market, then you're going to be wanting the ordinary shares, which are fully invested, because there'll be much less volatility in the new ones. But I think if you're a long-term investor, you can have a mix of each, and to some degree, it doesn't really matter. But I think you're probably going to have much more modest gains to come from the C shares in their early phases.
I think one point to mention here is that these C shares are being issued through a combination of placings and retail offers. That's what they say. And there will be no automatic preemption rights for the existing shareholders in Seraphim Space. So in other words, if you don't put in pro rata for your existing holding, you might not get some shares in the C shares if actually that's what you want. So that's something to bear in mind if you're looking at this. In other words, you really need to read the circular and look quite closely at what the deal is and listen to any of the roadshows that happen or any of the presentations that happen and try to make your mind up. But as you say, it's a good news story for the investment trust sector. I say I've heard some other mutterings about it, about this is a trust with a performance fee and so on, that may be worth looking at in terms of striking the right balance between the rewards to the manager and the rewards to the investors. But that's for another day. We need more details about that. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector each week and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content weekly newsletter, now available with a 2-week free trial. There you'll find our in-depth independent profiles of more than 200 investment trusts and much more content. Go to money-makers.co/circle for more details. If you like this podcast, do please subscribe to the channel and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Find all those links on the website, money-makers.co. Also on this topic of good news, fundraising, or early successes anyway, perhaps we could mention in this context Onward Opportunities Trust, ticker ONW. This is a very small trust that has been trading for a little while, but is about to move to the main market.
I really like to talk about this trust because I do feel this is very much a good news story, and one which I think is, again, possibly blazing a trail for other trusts to follow. So this trust began as a really small trust in March 2023, so only 3 years ago, and it began with just £12.8 million of assets, which, if you listen to most market commentators, they will say is way too small. Really, that's uneconomic. You can't attract any meaningful investment unless you have several $100 million in your investment trust. But actually, I think this trust has done very well. It's expanded, it's kept issuing shares, its performance has been okay, and it has grown now to have about £40 million worth of assets. And it's now moved up to the main market from the AIM, which I think is a really major step for the trust in terms of its credence in the market and its capability of attracting new investors and potentially raising more. And this could potentially raise more money because it's trading at a premium to its NAV, which again is highly unusual and I think reflects the standing of the manager and I think the way in which he's built his business. That's Lawrence Hulse of Dowgate Wealth. And if you have an opportunity to listen to a webinar or podcast or something by Lawrence, I think it's really worthwhile. He's a very good speaker. And the shares are on a small premium to the NAV. So I see this trust expanding a bit more. And I think it's very interesting. It has a very concentrated portfolio, which inevitably means its performance has been quite choppy and lumpy. So it does very much depend on exactly when you look at it, but it's had some quite hot runs, not over the last month or so, I have to say, but it's a very interesting trust and I think one well worth looking at.
Yes, I think it's one which I will be hoping to talk to quite soon on the podcast for those who are interested in these potential ACONs that could grow into something quite substantial. That has often been the case in the past in the investment trust sector. There are others who are following this kind of slow burn route, if we can put it that way. Ashoka White Oak Emerging Markets Trust would be another example that came to the market a little while ago and is now at 164p against an issue price of 100p. So it's sort of slowly gathering trust. It's up to 66 million market cap. But one has to say that to some extent, these are the future of the investment trust sector. Okay, we're going to lose a lot of companies in the sector, but they all started quite small at one point, or at least many of them did. Some of them came to market already quite chunky, but they are the seed corn for the future. So it's good to see them happening and also making some good progress. Let's talk about another very small company. We seem to be doing that this week, which has had its issues. And that is DGI9 Infrastructure, where for long-suffering shareholders, there has been more news to absorb. Perhaps you can tell us what's been happening there. This trust has obviously been a bit of a disaster since it came to market, but there are a number of people who think that it's still some value left in it. Tell us what the latest announcement is.
Well, a modicum of value anyway. Let's say, Jonathan, as you rightly observe, it really has been a terrible trust, actually. It's lost most of its value for shareholders. But there is a glimmer of light at the present time because a little bit of money is coming back. What's interesting here is that you may remember the trust had a significant holding in a company called Verne Global, where it was hoping to get quite a lot of extra money actually from an earnout, which at one stage seemed likely maybe to deliver many hundreds of millions of pounds. But actually, because of some terrible performance, this was effectively reduced to zero very rapidly. And interestingly, the board of Digital 9 have managed to negotiate a settlement, so it's given up its earnout rights for a £10 million settlement, which is much better than nothing. And that has enabled it actually to return £30 million now to shareholders, effectively around 3.5p of value for each share. And it's done that, actually, it's completed today. And the methodology was to redeem 37% of the shares at 9.28p per share, which was the net asset value. So you're getting a bit of money back, which will land in your broking accounts in 2 weeks if you are a shareholder. I just think, I mean, this is sadly just a few pennies on the pound, and it does leave the shares with a few small holdings left. The trust has a couple of holdings left, which may or may not achieve much value, but this is a tremendously speculative position now.
Indeed it is. But those who have been fishing for the bottom of this particular pool and were able to buy some shares at 5 or 6p, they've obviously had some money back and they'll be happy about that. And the shares have fallen back again since that news and since that payout. And they're now back around 5.3p, I think. Though if you're going to buy them, you probably face quite a big spread on them. So maybe that won't be the price you can get them for. So that's wrapping up nearly the end of a not very happy story. Let's go back to another much larger trust, and that is HarbourVest Private Equity. Now, this is an interesting one because this week it's announced a whole series of measures designed to tackle the difficulties that most private equity trusts have been facing in the last 2-3 years. very wide discounts and gumming up of the private equity market. So they can't actually sell and recycle capital as quickly or as efficiently as they were used to doing in the past. So perhaps you could fill us in on this one, Andrew. I should just mention that this is a trust which has a market cap of around 2.2 billion. So we're talking about a very serious entity here, and it operates as a fund of funds private equity trust.
It does. And this is a sector-wide problem, the wide discounts here. So across the private equity fund of funds sector, the average discount is 28.7%, which is very wide. And actually, it tends to be that way. But of course, trusts are no longer able just to shrug their shoulders and say, well, that's the way it is in the market. They really do have to address these discounts or find themselves the target of arbitrage activity, as we've been talking about. So I think the discount has been really moved up to the top of the agenda for most boards. And there are various ways of trying to tackle that. And I think HarbourVest, which is the largest private equity trust listed in London, apart from 3i Group, this is really blazing a trail here. And I do think that other trusts in the sector will be really taking notice of how this is received by the market and what happens. So what the situation is here is that HarbourVest Global is on a 26.4% discount. And that discount has been stubbornly wide. It has come in a bit. I remember its widest levels being around 40%. So it has come in a fair amount, but it's still very wide. And it's been stubborn because actually the trust has really tried with buybacks. It spent quite a lot of money on buybacks, I think about $260 million over the last 2 years. So you can't say it hasn't tried. But it's coming up now to a continuation vote in July that has really concentrated the mind of the board, I think. So it's going to expand its effective capital repayments very significantly. So it's going to continue with $100 million of buybacks in this current calendar year. But on top of that, it's planning a $400 million tender offer in the autumn so that shareholders can tender some of their shares at around a 10% discount to NAV. And this is part of a broader strategy now to aim to distribute between 5 to 10% of its net assets annually back to shareholders until the next continuation vote in July 2029. And my feeling is that this is really about the trust shifting its priorities. It said it's not going to invest any more capital for the moment. It's really concentrating on putting all of its realized capital into this distribution pool to pay back to shareholders in some way. And the plan is that shareholders can then see the brighter, sunny uplands ahead. They can see they're getting money back at closer to net asset value, so they'll want to stick with the trust. And I understand the necessity of this. The board is under pressure to try to reduce this discount. But the trust is going to need to sell some more assets in order to do this. And of course, the key here is that it's not going to be investing any new money. So yes, it's fine that you're getting money back at closer to NAV, but I'll come back to the same point again. That's a short-term gain. And if you're a long-term shareholder thinking that you might own this for 20 years, you've got to look forward and wonder what impact this lack of current investment is going to have on your future returns. So I just feel this is very much driven by pressures in the markets, and I'm not really convinced it's a fantastic long-term strategy, but this is what's going to happen for the next 3 years anyway.
Yes, and I suppose you could say that it does show that the board has been listening to shareholders. These are the kind of proposals that wouldn't have been put together without quite a lot of consultation with some of the larger shareholders, I think it's fair to say. And they seem to be kind of throwing a whole series of things up in the air, sort of little things which they hope in combination will change sentiment in the market. But the fundamental underlying problems at the moment in the private equity market don't seem to be getting any easier anyway. We haven't yet seen the market begin to ungum, if that's a word, because they're having to hold on to their investments longer and so on. And this is a fund of funds private equity trust which has a higher level of fees as a result and less flexibility in what it can do. Well, it'll be interesting to see whether this does do the trick or not. I think it's fair to say that HarbourVest is trading on a narrower discount than many of the other larger private equity trusts, and it's up 4 or 5% since the start of the Iran war. So it seems to be doing some of the right things, whereas other large private equity trusts are still trading on much wider discounts. So maybe there is a lesson from that. at least in the short term, as you correctly point out. Talking of which, I just want to quickly mention Pershing Square Holdings, which is another very large investment trust, which has ambitions to become, or at least the founder, Bill Ackman, has ambitions to have a much bigger empire at his disposal, well-known hedge fund manager in the US, and is proposing a couple of launches in the US, which are now underway, I think.
They are. So Bill Ackman, who is the man behind this trust, is a well-known, colourful figure in the US markets, and he seems to me to be a restless soul, actually. He's certainly very vigorous and a man of great energy because he's pursuing several projects at once now. One which we have talked about before is that it's proceeding now with a new US closed-end fund listed in New York, which is a very sizable trust it's going to be. It has backing of at least $2.8 billion, but maybe as large as $10 billion. And that's going to be completely separate from Pershing Square Holdings, the listed London entity. But there will be some benefit in terms of reduced fees actually on the London Trust. So it is helpful. The other thing that struck me is that actually, if you're asking US investors here to pay asset value for shares in this new fund, it's got to throw some light on the London listed fund, which is on a 25% discount, clearly offering better value. But anyway, there we are. We'll see whether there is some discount narrowing to come from that. But at the same time, Bill Ackman is pursuing lots of other things. So he's also trying to create a new IPO listing for Universal Music Group by effectively merging that with a SPAC construction that he previously had. So he's a busy man. And you say, actually, this degree of activity hasn't helped in the short term. The trust's performance year to date has not been tremendous. I think it's down 4.3% in NAV terms, somewhat behind its peers. But I always view Pershing Square Holdings as a special situation. I do feel actually that Bill Ackman is pretty good at creating value over the long run. And this trust is really not very correlated with others in the North American market at all. So in spite of its size, in spite of this being a FTSE 100 constituent, I always see it as a special situation.
Yes, it's also interesting, I think, another thing to mention. I mean, I think he's looking to raise some money for his management company as well, is he not? And history might suggest that could be a more lucrative journey than necessarily investing in the things he's managing for you. But you have to call me an old skeptic on that one, I think, probably. But when large funds do well, the managers also do well, and they have a geared exposure to it. So that might be worth a look. So while talking about raising new money, you've come up with a very interesting, perhaps off-the-wall type investment that is also going to be coming available quite soon. And I'll leave you to explain what it is, Andrew, and why you picked up on it this week.
This is indeed quite offbeat, and I dare say some of you might block your ears as soon as I tell you what it is. But we have to mention it because this is potentially the first IPO in the sector since Achilles Investment Company came to the market in March 25. So there's quite a lot of excitement around just something new arriving. So let me tell you what it is. This is the National Investment Fund of the Republic of Uzbekistan, or UZNIF as it will be known. And this is indeed investing in Uzbekistan. This fund already has about $2.4 billion of net assets, so it's fairly substantial. And effectively, it's seeking an IPO for its existing structure. It has holdings in state-owned enterprises across transportation, energy production, telecoms, utilities, and banking. So it has around 13 holdings, minority stakes in these state-owned enterprises. And it's going to be managed by Franklin Templeton, so a well-known name there for us. I think it's going to be intriguing. Now, first of all, we don't know enough about Uzbekistan to form a judgment. This is a landlocked country in Central Asia, and beyond that, we probably don't know too much about it, but it'll be fun to learn more. I suspect as well there'll be a fair degree of skepticism about these state-owned enterprises. I mean, we know, I think, Jonathan, that many emerging markets managers say they steer well clear of any state-owned enterprises because actually minority shareholders are not always treated well. But this is the National Investment Fund of the Republic of Uzbekistan. It's government-backed, and so I think they would like to see it do well. At this point, we don't know when it's going to arrive, what the format will be. We've just had some really news in advance here. So we will have to start learning about Uzbekistan and see what the prospects are. My feeling is that for most private investors, this is going to be somewhat too esoteric and probably won't be making their way into our portfolios, but you never know. We'll have a look.
Well, that's interesting in this sense. It gives me an opportunity to mention the fact that this week we learned about the passing of Mark Mobius, who was the first manager of the Templeton Emerging Markets Investment Trust, which in turn was the first investment trust to specialize in emerging markets back in 1989, I think it was. Now, I had the good fortune to meet Mark Mobius a few times, and I wrote a chapter of my book about it, a book that I wrote about 20 years ago and updated about 13 years ago, which was a series of profiles of prominent investors. And if you are a subscriber to either my Substack feed or the Moneymakers weekly newsletter, you will find a link to the chapter in that book which I describe what Mark Mobius did, what he was like, and how he set about creating the world's first emerging markets investment trust. He's a very interesting character, very high profile, very energetic. And mention of Uzbekistan reminds me that when I spoke to him for one of the times, he'd just come back from Tashkent, which, as you all know, is the capital of Uzbekistan. And it was an example of his extraordinarily giddying global itinerary where he shot around from one country to the next, from week to week, and sometimes from day to day. And if you're interested at all in emerging markets and the history of them, and the history of the Emerging Markets Investment Trust, which he stopped managing about 13 years ago, I think, you can find that either on my Substack or you can find it on the Moneymakers website. So please do have a look at that if you are interested in that particular topic. So that brings us to the end of this week's podcast. My thanks to you, Andrew, for your usual sage comments and understanding of what's going on. As always, news every week for us to talk about. There's other topics we could have talked about but haven't. There's a new carbon pricing structure which is going to affect the UK renewables. We haven't mentioned that, not in a positive way, I think it's fair to say, and other things we could talk about. But for the moment, that's it. We'll be back next week with another special edition of the podcast. This one is one I'm recording at the Master Investor Show in London next Saturday and will be released the following week. I'll be joined on stage by Peter Hewitt, the recently retired manager of the CT Global Managed Portfolio Trust, who is well known to podcast listeners. And we will be doing a Answer Your Questions session, where both of us now being unaligned with anything, without anything particular to sell, we're not employed by anybody to promote anything, we will be trying to answer some questions, such as what have we been buying or selling, what impact will the Iran war have, where will Saba go next, all those sort of questions. We will be trying to tackle them head on, risking making a fool of ourselves, but that's the plan. And if you want to come and listen at the Master Investor Show, I strongly recommend it. It's always full of interesting speakers. And Jim Mellon, who founded the show, gives a long presentation, is always worth listening to, a very successful hedge fund manager. And if you're a subscriber to the Moneymakers newsletter, you can get a free ticket from us for that event, which lasts all day next Saturday at the Business Centre in Islington, North London. I think the doors open around 9:30. So that's it, and hope to see you there. If you are a podcast listener, I know many of you do go to the Master Investor Show. I will look forward to having a catch-up with you there.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode, and follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.